Is the Fed about to embark on an emergency 25 basis point rate hike?
All I know is my gut says maybe.
But there might be a 5 basis point rate hike if something screwy is going on in the overnight repo and reverse repo markets. This is Rafi, the Endgame Investor, going to try to dispel the notion that gold shot up to 1860 on Friday because of Putin and Ukraine, which I do not think is the answer. There has been some speculation that the Fed will embark on an emergency rate hike by Monday. I've seen this 3 sources, Zero Hedge and Daniel Oliver of Mermicane Capital and Bloomberg, coming from James Bullard, who is one of the token hawks, who's not really a hawk, but compared to all the massive money printers on the Fed, he's like an emasculated hawk. There was a time, said Bullard, when the committee would have reacted to something like this, having a meeting right now and doing 25 basis points right now, Bullard said. I think we should be nimble in considering that kind of thing. I do not think it is shock and awe talking about rate hikes, Bullard said, noting that markets are already pricing in significant moves. I think it is a sensible response to a surprise inflationary shock that we got during 2021 that we did not expect. So you're telling me that a bunch of MIT economists who are all supposedly geniuses got an inflationary shock they did not expect after they printed about $4 trillion and locked down the entire country so nobody could produce anything. So you were going to have a much higher money supply with a much lower goods supply, and you weren't expecting an inflationary shock? The truth is, they were expecting it. They knew it was coming. They know what's coming now, and they're just lying to all of us to keep us holding on to our dollars so that they can keep inflating and buying government bonds and keeping the engine of theft going. But sooner or later, we are all going to dump the currency and revert to real money, at which point they will lose control entirely. That is what they're trying to avoid, and they can only do it through psychological warfare. Considering a 25-point emergency rate hike in between FOMC meetings would completely freak out the markets. And I think this is exactly why gold jumped up to 1860 on Friday, because there were rumors that a 25 basis point rate hike emergency would be considered by the Federal Reserve. And this was because of short-term Fed funds futures trading. Fed funds futures are contracts based off of the federal funds rate, which is the rate that the Fed either hikes or cuts overnight. And trading in those futures for February, for this month, meaning before the next FOMC meeting, which is in March, the February Fed futures contract traded on Thursday and Friday at 13 basis points, which is 5 basis points higher than the current overnight Fed funds rate of 0.08. That means the market, the futures market in federal funds, in that interest rate, was anticipating a 5 basis point rate hike, not a 25 basis point rate hike, because the rate was 8 basis points and it was trading at 13. Why would the Fed be considering a 5 basis point rate hike? And the only thing I can think of is that something screwy might be happening in the reverse repo markets. Reverse repos are overnight transactions that banks do with the Fed to loan the Fed cash in return for 5 basis points of interest. Now, if the Fed raises rates above 5 basis points, all of this money, $1.635 trillion every night that is stuck in reverse repos, will look for higher rates to plug themselves into to earn that higher interest. And so, with interest rates starting to rise and the Fed promising a rate hike of at least 25 basis points in March, it could be that some of this money will imminently start to leak out into the banking system to earn the higher interest that is being earned on the front curve right now because of rumors of Fed hikes. In order to keep this money stuck in reverse repos instead of in the banking system, because if you have $1.635 trillion floating in the banking system in a very short period of time, you're going to mess with a lot of stuff with consumer prices and with short-term interest rates. So in order to keep money into reverse repos, it may be that there could be possibly a 5 basis point emergency rate hike to increase the rate that banks earn on reverse repos from 5 basis points to 10 basis points and keep that money out of the banking system. All this money is there. It cannot just disappear. It is going to leak into the banking system at some point, and it could be that the Fed is trying to stop it, and that might be why the Fed futures were trading briefly at 13 basis points instead of 8. Now, the question as to why gold rocketed to 1860 on Friday. Was it because of Russia and Ukraine and a supposedly imminent Russian invasion of that country? I contend no. I believe it was because of the rumors of an emergency Fed rate hike. You see, one of the biggest myths in the gold market is that interest rate hikes push the gold price down. It is entirely and demonstrably, empirically false. And here I'll show you very simple work by Daniel Oliver of Mermicane Capital, which proves conclusively that higher nominal interest rates push the gold price higher. 3 separate examples. Here we go. Here's Daniel Oliver in his latest research report, February 11th, 2022. Gold also rises. So does the sun. Bernanke raised rates from mid-2004 to mid-2006, during which time gold surged from $400 to $700 an ounce, a 75% increase. A similar move today would put gold over $3,200 an ounce. Then again, the Fed raised rates from the end of 2015 to early 2019, and gold moved 24% higher from $1,050 to $1,300 an ounce. This phenomenon is not confined to this credit cycle. From 1972 to 1974, the Fed raised the Fed funds rate from 3.3% to 13%. Gold ran from $45 an ounce to $180 an ounce, a 300% increase. Then again, from 1977 to 1980, the Fed hiked from 4.5% to 20%. Gold, having fallen nearly in half from peak to trough, surged from $130 an ounce to $850 an ounce, a 550% increase over 3 years. So it is a myth that rising nominal rates are gold negative. They are not. What pushed gold to 1860 on Friday? No, it was not a Russian invasion or an imminent Russian invasion of Ukraine. It was rumors of the Fed hiking rates in between meetings, which would send a very clear signal to the money markets that the Fed has lost control of the monetary system. And what happens when the Fed loses control of the monetary system? And it is guaranteed that they will. The only question is how much time, and I do not believe it will be more than months at this point. Here is a book, 2 passages from a book. Here are 2 passages from a book by Gettr, written in 1932, that describes what is going on now to a T. This book is called The Bubble That Broke the World, about the mania of the 1920s that led to the depression of the 1930s. Cosmology of the bubble. This is the first paragraph of the book. Mass delusions are not rare. They salt the human story. The hallucinatory types are well known. So also is the sudden variation called mania, generally localized, like the tulip mania in Holland many years ago, or the common stock mania of recent time in Wall Street. But a delusion affecting the mentality of the entire world at one time was hitherto unknown. All our experience with it is original. In the 1920s and 1930s, that is what happened. There was a mania in the entire world, reflected in the US as the Roaring '20s, that led to a global depression as the global bubble deflated. This time, the only difference is the bubble is not going to deflate. It is going to explode.
It turned inside out?
And it exploded.
The Fed can just keep printing and printing to keep the bubble going, and they can keep the bubble going for as long as they want. But this time, if they keep the bubble expanding for too long, the people will make that bubble of infinite size, which means the dollar will go to zero value and prices will climb to infinity. Here, Gettr describes how that happens. But let the faith be broken. Let the delusion arise that the fiction is the reality. Let the limit upon the amount of credit that shall be set free be left to imagination, meaning let the Fed print and print without any limits. And presently, there is no way of telling what anything is worth by pricing it. For a while, this difficulty of not knowing what anything is worth but inflames the ecstasy. Everything will be priced higher and higher to make sure it is high enough. There will be the illusion that things are becoming dear and scarce. They seem to be dear because the value of the money and credit in which they are priced is falling. They will seem to be scarce because people are buying in the expectation that prices will go higher and buying in expectation that prices will go higher and higher still. Suddenly doubt, then coming awake and panic. The spirit of gold has been debased by senseless inflation. The faith is lost, all with one impulse. People rush to seize the gold itself as the only reality left. Not only people as individuals, banks also, and the great banking systems and governments do it in competition with people. This is the financial crisis. Now, my contention is that this process has already begun. How can I prove that? How can I show you? First, watch this little clip from Jeff Curry of Goldman Sachs, who seems to think there are shortages everywhere.
2008 was a financial crisis. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it.
We're out of everything? How all of a sudden are we out of everything? What changed from 2021 to 2022? All of a sudden we don't know how to produce commodities anymore? I'll tell you what happened. All the money that was printed in 2020 suddenly made it into the banking system, and now there's way too much money chasing way too little stuff. So prices cannot equilibrate again, and it looks like we have a shortage, but we don't. We have plenty of stuff. We just have too much money chasing it. It's the dollar that is dying, and it's not commodities that are in a shortage. That is what Jeff Curry simply cannot wrap his head around, because he's only been around for 30 years, as he says, and he hasn't been around for a hyperinflation, which happened before he was born. Now, remember, with that clip in mind, what Gettr said about things seeming to be dear and scarce. What he said was there will be the illusion that things are becoming dear and scarce. They seem to be dear because the value of the money and credit in which they're priced is falling. But what is actually happening? Here I will show you two charts to show you exactly what is actually happening, what Jeff Curry doesn't see. But if you looked at these charts, he probably wouldn't see it anyway because he doesn't want it. Curry talked about commodities getting scarce. Well, if we look at the price of commodities since 1990, this is the Reuters Jefferies CRB Commodity Index. It hasn't changed all that much. I mean, we have here a CRB index of around 235 in February 1990, and now it's 263. So first of all, even in dollar terms, commodities are not that expensive yet right now, except there are backwardations everywhere, meaning the spot prices of many, many commodities are higher than the futures prices of those commodities, which means a physical shortage. Is there really a shortage of commodities right now? The answer is absolutely not. What there is an excess of money. People trying to dump the extra money into real assets to have something of tangible value, and I can show you that right here. This is that same CRB chart, except priced in gold. You can see here that since 1990, commodities have gotten much, much cheaper in terms of real money. It costs much less gold to buy the same basket of commodities 30 years ago than it does now. What is that showing you? It is showing you that what is scarce is real money. Money substitutes, meaning the dollars are being poured into commodity markets to get rid of them. So it seems to be becoming more expensive, but what is really happening is the dollar is dying. That is what Curry does not understand. He says he hasn't seen this in 30 years. Well, if he'd been around for 40, 45 years, he would have seen and remembered what happened in the late 1970s and 1980 when there was a near hyperinflationary scare of the dollar. That is what is happening right now, except this time the Fed cannot stop it. There is no shortage of commodities. There is a shortage of real money. because people, while stuffed with dollars, do not have gold. And as the realization of what is happening in the commodity markets, meaning it's not that commodities are getting more expensive, it's that the dollar itself is collapsing. Once that change in psychology, and that is all it is just psychology. Once people realize that it is money itself that is dying, which has happened again and again. And it's a switch, it's a click. Once it clicks, everybody chases for gold and silver at the same time. And once that happens, nobody can get any of it. And it stops being exchanged for dollars. And instead, gold and silver become exchanged for goods and services directly. That is the end game. That is what is coming. That is what Jeff Curry does not understand, because he can't wrap his head around the fact that the dollar is not money. It is a money substitute for gold. This is Rafi of the Endgame Investor. If you want to know how I am preparing for the Endgame and how I am preparing my subscribers for the Endgame, please sign up for a 2-week free trial of the Endgame Investor at the link in the description below. And if you're interested in anything else I have to say about important topics, and I do videos every week about my libertarian commentary on the Bible, which you can get a weekly installment of by becoming my patron on Patreon for as little as $3 a month, link in the description below. We're running out of time. There are only a few months left. Stock up on money, on gold and silver, and food and water. And if you drive a truck, you know where to go.